first, I'd like to thank BDO for having us today in this great space. I'm hoping we can come here all of the time. And really excited to have our speakers today, Kyle and Matt. I'm not going to pretend to give their intro because they're going to do it much better. But I really quickly did want to share some upcoming lunches that we'll be having. So next month in May, we're going to be having our lunch around Jersey. It is Jersey Week. Daryl, you can correct us at some point, but we have a whole bunch of folks in town to celebrate Jersey as a jurisdiction. So we're going to talk about that. In June, we are going to have our lunch series around Italy, cross-border planning, U.S.-Italy. July is going to be global mobility. That's a lunch that we did, I think, around 18 months ago, and it was really successful with Lee Basha, Judy Gulst, and rest of the year is still TBD, but it's going to be great. Hope all of you can join us. And really quickly, I'm just going to share a little bit about Kyle and Matt's backgrounds. So Kyle is a partner at FRB and a member, or maybe the head of their digital assets practice. To me, he's the head of it, so that's what we're going to call him. He advises clients on a wide range of corporate and transactional matters, including private placements, mergers, and acquisitions. And we're really excited to have Matt in town from Colorado. He's the co-founder and CEO of Bespoke Group. And Matt helps ultra-affluent, globally mobile families create order, continuity, and meaning in their wealth. So before we turn it over to you guys, I'm going to give the floor to BDO for a minute and hope everyone enjoys.
Thank you. I'm joined here by my colleagues Lydia Vercelli and Rachel Anderson on behalf of BDO and the private client team here in New York. We just wanted to thank you all for coming, and you're welcome to come anytime you want to. We also do a lovely happy hour here on everyone's way home from work. So without further ado, I will pass it to our speakers.
Great. Well, thanks for hosting us. This idea was hatched when I met Murray several months ago, last time I was in Manhattan. And we circulated some materials to you guys in advance, but we don't have a slide deck that we're going to walk through necessarily. Kyle and I were talking about this, and we've been through plenty of continuing education presentations during our time in practice, and the last thing I think any of us want to do is troll through a slide deck. So with that, let me kind of make it just a quick introduction about how I got started in the digital asset space, because I think it might be relevant for other practitioners in this room, and then Kyle, maybe you could do the same thing from your perspective. So my background is as an estate planning attorney. Ever since I graduated law school in 2000, all I've ever done is trust and estates. And my practice took me into the ultra-affluent space. I also spent about 10 years of my career where my primary focus was preparing and presenting continuing education to other attorneys. I started a law practice in 2017 with a good friend of mine named Jonathan Mintz. Jonathan started the STEP chapter out in Orange County, which is where he was when we partnered up. And so we formed a law practice in April, I guess, of 2017. Because of our background in education, very quickly we started getting co-counsel and referral opportunities from other colleagues in the space. And it was in that context in November of 2017 that I got introduced to a client with about $150 million worth of Bitcoin. At the time, I had no idea what Bitcoin was. I hadn't even heard of the word Bitcoin, I'm sure. But being a curious guy and really wanting to learn about these people who have this asset and what this asset is, I jumped in and started understanding what Bitcoin is. How do you own this thing that is just a digital representation of value? And so along the way, as we were doing work for those clients, we started getting more client referrals for people who had similar situations. Clients who had thousands of Bitcoins that they mined when they were in graduate school, or a woman who took possession of thousands of Bitcoins when she divorced. And so all along the way, we just did more and more work in this space. And as our practice continued to evolve, those clients wanted more services from us. They wanted us to manage real estate portfolios for them. They wanted us to manage their block trades for their Bitcoin possessions. They wanted us to facilitate their banking relationships because they were being debanked by banking regulators. And so all along the way, we just kind of kept getting pulled in the direction of providing more comprehensive services to clients. So then in 2022, we decided to start restructuring, and we formed a Bespoke Group, including an SEC registered arm to then be able to provide comprehensive financial services to clients. We then sunset the law practice in 2024, and so now we provide global wealth management services for clients. I was talking to Max at the beginning, we don't just do Bitcoin and crypto. That's just what we started doing. Our clients want a full service of asset management, private banking, help in designing and supporting their estate planning strategies, tracking all of their wealth for them, and then sometimes helping them run their own private trust companies and other companies like that. So anyway, long story, but it started for us in November of 17 just by starting to explore what this asset is. And so along the way, the stuff that we learned along the way is some of the stuff that we'll be talking about today.
Thank you, Matt. Thank you, everybody. You really have happy hours in here? I'm just curious about the logistics. Thank you all for having us. We appreciate everybody's time. Thank you, BDO, for hosting. Thank you, Danielle, for spearheading the effort, which, as far as I'm concerned, you did. Kyle Lawrence, FRB, as was introduced, as you already know. But quick show of hands, who here actually owns any Bitcoin? Good amount. Actually, more than I expected. That's good. Just somebody, whoever wants to volunteer. What was the impetus to make you buy it? Who wants to share? Yes, ma'am.
My son wanted some,
Excellent.
and he made me buy it.
You're a great mom. That's really nice.
How long ago was that?
I want to say 5 years.
Wow.
Is that right?
You're an amazing
Maybe
mom.
3 years. 3 years.
Yeah.
Sorry.
I take that. You're great. Very nicely done. So, while Matt is a recovering attorney, I am still very much actively in the throes of a thriving legal practice. I've been at it about 20 years now, and my first foray into the world of cryptocurrency was really more of a blockchain introduction. It was a seminar at Old Burton. Remember those guys before they got accumulated? This was 12, maybe 13 years ago. Were you there? You remember that? And I just remember sitting there and the guy was talking. I was like, I don't know. I understand some of what the guy was saying. It's like, but this sounds crazy and far-fetched to me. And then slowly over time, I saw just more and more headlines and saw more and more of the possibilities. And really, when I joined Falcon Rappaport Berkman in June of 2021, one of the other partners, Boyce Belts, actually came up to me and he said, look, you're a securities attorney, you're a corporate attorney. We're getting all these inquiries for people trying to launch NFTs, and we don't know if they're securities offerings or not. We don't know what we're doing. We don't know the corporate wrappers that you need to put around these things. All of those basic questions you would ask about a traditional business now applying to these things. And I was like, well, candidly, I don't really know a ton about it, but it seems interesting enough. Let's see what happens if I just kind of dive in. And that was what I did. And I opened up a Coinbase account and I started buying some Ethereum and playing around and made some mistakes as all of us do when we first get into a new industry. But I really saw the writing on the wall, specifically with Bitcoin and other cryptocurrencies, even at that time. I saw the possibilities of an updated payment system as opposed to what we are still using now, which, I mean, I can talk war stories of what keeps me up at night when a wire transfer is initiated at 4 o'clock in the afternoon, and then you're just waiting and waiting and waiting, and the moon can crash into the earth, and God knows what can happen. Sorry, I got off track, let's leave that on the side, it's really upsetting. But Bitcoin can solve a lot of that. Bitcoin can solve a lot of the real world log jams that we have that in some cases we don't even necessarily realize that we have. Title insurance, putting contracts on chain, just simple things that can really solve a lot of problems and do things more efficiently. And with Bitcoin specifically, you always hear the adage, oh, it's just a store of value, that's all it is. But it really does open up a a lot more possibilities, not just for the way we do business, but for our own personal investment strategy, our own portfolios. You know, Matt can delve more into the strategies that he employs, that his team employs, and then we on the legal side then actually, you know, implement a lot of the strategies that he comes up with. But it really is kind of a new frontier for us. And believe it or not, everybody here, it's good that you're here because we're still early. There's still so much work to be done, so much development to be done, and the fact that you guys are here and you're going to listen to us, just I commend you for it.
So those of you who are estate planning practitioners, I'm guessing that you're all in the space in one form or another. Otherwise, you're probably in the wrong room. What are some of the questions that your clients are asking you right now in your practice?
The Socratic method, just call on somebody. I don't want to do that. Well, what's the most common question that you are asked with a new client who comes in?
Well, there are several. One is, how do I substantiate my basis for capital gains tax purposes? They don't ask it quite like that, but they say, you know, my Bitcoin has, you know, I bought this Bitcoin, or I got this Bitcoin years and years ago, and now, I mean, it's gone from zero or near zero to today it's around $75,000 per Bitcoin. Multiplied by hundreds, or in some cases thousands of Bitcoins, not only is that a lot of dollars, it's also just a lot of gain in percentage terms. And if they happen to be a U.S. taxpayer, if they happen to be a California resident, an Illinois resident, an Oregon resident, a New York resident, someplace that has very high state level income tax as well as federal income tax, when you show them the numbers of how badly it's going to hurt when they simply liquidate the Bitcoin or other crypto assets, they start to ask, what else can I do with this asset? And so we're fortunate in that a lot of clients that we get to serve are very philanthropic. And so one of the, and for those of you who've been in the space, one of the things that you should be thinking about is it CRUT season? We have helped clients establish charitable remainder unit trusts is kind of our preferred model instead of an annuity trust. But charitable remainder unit trusts can be a really attractive vehicle to generate an upfront income tax deduction based off of the value of the remainder interest when you put the Bitcoin or the highly appreciated asset, Bitcoin, crypto, or otherwise, into that trust, and then you liquidate the Bitcoin in a tax-free environment. Now that gives you the ability to generate an offsetting income tax deduction the year you create the CRUT, liquidate the Bitcoin or crypto income tax free, and then pull an income distribution off of that trust. That carries with it its income tax incrementally, but you can slow down the appreciation of income tax simply by creating a tax deferred liquidation event through a charitable remainder trust. So we do a lot of that work for our clients. I'll kind of stop there for a second because I think I said a lot, but what questions does that prompt? Well, Matt, one of the questions that prompts is, how do I get Bitcoin in trust in the first place? Because here we have a digital bearer asset. It doesn't exist in physical form. It is an entry on a ledger. Well, who keeps the ledger? Well, the ledger is distributed globally. In the case of Bitcoin and other blockchains, we don't have a centralized ledger that keeps account of who has what assets. The ledger that keeps account is distributed globally. But how do we transfer an interest like a bearer asset, I think it's really noisy, to a trust? The problem we're trying to solve for is we're trying to establish legally recognized fiduciary title ownership to this asset. We know how to do this with equities. If we have equities sitting at Schwab or some other custodian, we can simply transfer the ownership of the account from an individual's name to the name of some trust or some structure that the client creates. How do we do that with a bearer asset? Well, in the case of gold, we would have to have a custodian establish a gold custody account somewhere, and then we would have to physically move the gold from the creator of the trust, settlor in this case, to the custodial vault managed by the trustee. How do we do that with something like a digital asset? Well, it's very similar. We can have a trust, in this case my CRUT, would open up a qualified custody vault at a qualified custodian. Maybe it's BitGo here in New York, or maybe it's Anchorage in California, or in Singapore, or someplace like that. And the client would then transfer the Bitcoin from a wallet they unilaterally control to a wallet controlled by the trustee. We can do it exactly the same way we do with any other asset. The mechanics get a little bit complicated, but functionally it works exactly the same way.
Yeah, I want to circle back to something that you mentioned before, which I think gets at the heart of what blockchain is, because I think just understanding helps understand what Bitcoin is, because the two things are very different. You mentioned the word ledger. At the end of the day, that's really all blockchain is. It's just a ledger that we can all look at and see who owns what. And you can look and see anything. You can check an NFT or a specific asset and see who bought it when, what they paid for it, how many times has it been sold, and so on and so forth. And why is that important? Well, if I keep my money in the bank, they're the gatekeepers, and you have single points of failure in that mechanism. If the bank makes a mistake, well, then who fixes that? Because sometimes if you can't get them on the weekend, you may have to wait a couple days in order for them to fix it. Blockchain doesn't have that. It's a publicly available distributed ledger that anybody can look at. And when I talk about, like I did before, about a better way of doing things, a better mousetrap, that's kind of the simplest way to break it down and understand it. And that's what I think makes this a lot attractive to people who, you said the word debanking. That's why. If you can, and I'm not saying run on the banks, but if you keep all your money in the bank and you want to have more ready access to it, well, this is a different way of doing that is very attractive to a lot of people who want to be nimble with their funds and want to be flexible and want to have a more diverse portfolio. I think it's a really important thing to understand that gets kind of washed over. People don't really understand why that's important, and I think that everybody here uniquely understands that better than the average person who just watches TV and sees somebody making $100 million selling cat pictures. That's an outlier. That's not what we do. We try to help people create a more diverse portfolio, a more flexible portfolio, and one that can inure to the benefits of their heirs and their kids and their grandkids. And as Matt was saying, when you have a share of stock, you just contact the transfer agent. It's more complicated than that, but that's what you do. Here you don't have to do that. You don't have to write a legal opinion to move Bitcoin from point A to point B. And to me, that's an attractive option.
So what challenges do you face with customers who come to you and they'll say, what a great structure for that structure to own the digital assets? I mean, that in itself is a big leap of faith. How do you navigate that?
Yeah, so that's the biggest question. So the question for those who might not hear her is, what does a conversation look like when you're talking to a client about moving Bitcoin or some crypto asset from unilateral custody to something that is structured? That is the biggest hurdle. For us, a lot of it goes around education and sizing. We've done a lot of work. We've done a lot of work on this, and we've got a white paper on our website where we talk about this. But I would say it's definitely a journey, and it takes a lot of education, because we talk to clients about what are the consequences if you don't have structured planning around your digital assets. Well, there's the worst case scenario, which is they end up dying, become incapacitated, and there's not a built-in succession mechanism to allow the people that they care about to actually be able to manage those assets. If I have unilateral control over my Bitcoin and I have a stroke, I get run over on 6th Avenue, Anything happens to me, my wife, my kids, really don't have much hope in recovering my digital assets from me. So with that unilateral sovereignty comes unilateral risk. I become the weak link in my ownership regime. So part of the conversation goes to succession. Another part of it goes to asset protection. Because if I have unilateral control over the assets, then we can suspend for a second the question of whether or not the client would actually disclose if they have the Bitcoin. But legally, we know that they must. So if I'm a client and I'm being deposed because now I'm in a divorce proceeding, or I've had a business litigation, or something has arisen, I have to disclose all of my assets, including my ownership of this Bitcoin. So I have no asset protection. I have no succession mechanism in place. I also have no tax optimization in place. When I do later want to liquidate those holdings, I will have capital gains tax liability. The value of the Bitcoin will be countable in my estate from a transfer tax perspective. So I've really done no structuring around my Bitcoin. And so some people will say, well, I don't have enough Bitcoin to make that material. Maybe the total value of my Bitcoin is only $10,000. I'd say that's not really a problem. Okay, well maybe the total value of my Bitcoin is $100,000. Okay, well maybe that might be economically material for my family. Maybe the total value of my Bitcoin is $1 million or 10 million, or as the number goes up, the risk and the need to structure the Bitcoin holdings goes up. So the way we help clients think about it is, to the extent you do not have a federally taxable or maybe state taxable estate, you probably don't need a tax optimized structure in place for that. However, you do need to be thinking about what happens in the event of death, disability, things like that. Well, there are some really elegant structures called multi-signature wallet constructs. So instead of me having unilateral control over my Bitcoin, perhaps I allow my wife and my kids to also have signature control under what's called a multi-signature regime. It could be controlled by an app on my phone, it could be controlled by peripheral devices, that I log into a website, but it would allow me and or my wife and or my kids to move the Bitcoin by consent of a quorum. Maybe we say 2 out of 3 signatures on the wallet are necessary to move the Bitcoin. So I get run over on 6th Avenue, I have a stroke or whatever, my wife plus my kids, they still have the ability to move that Bitcoin. So I have I've solved the succession mechanism problem. Now I've not solved the tax problem, and I've also not solved the asset protection problem, but I have solved the succession problem. Now, when the value of Bitcoin becomes really economically material, to the point where I need to be thinking about asset protection in the event of lawsuit, I need to be thinking about tax mitigation in the case of estate tax, gift tax, capital gains tax, things like that. Then we say the difficult truth is, to the extent you want fiat-based outcomes, that is outcomes that are part of the normal legal and tax system, if you want fiat-based outcomes, you have to have fiat-based solutions, which means you have to use an ownership regime that has legal recognition under applicable law, whether it's New York law, Colorado law, or federal tax law. So the conversation with clients go, okay, what is it you're trying to solve for? And then the solution that you need depends on the outcomes that you're looking for. I think the last thing I'll say on this is that for all of our client conversations, the answer appears somewhere on the spectrum. To the extent your Bitcoin use is transactional, you're going to be buying and selling, you want to go to a coffee shop and buy a round of coffees for your friends, you don't need a structured solution for something like that. Keep it on a hot wallet, accessible by your phone, it's going to be totally fine. To the extent it becomes economically material, maybe you have a revocable living trust, you have that revocable living trust, establish a multi-signature vault using something like Casa or Unchained or some other multi-signature wallet provider like that. And then to the extent you're looking for tax mitigation, then we have to go down the route of some type of fiduciary, title-owned structure with a legally recognized custody solution in place. I guess there is one more final thing I'll say about this. The conversation around visibility to, we're kind of jumping ahead, I think, but it's probably worth it. Kyle's talked about Bitcoin and these other digital assets being on a publicly available ledger. That means that you can have the blockchain wallet address, that's a public address, that's visible on chain. You can see the number of Bitcoins or other digital assets that reside at that address. Giving the client visibility to the address to which their entity is, of which their entity is the owner, gives the client some comfort, saying I've got 50 Bitcoins sitting at this wallet address, that wallet address is titled to the trust. That seems to go a long way. And then from a structuring perspective, very often we'll employ the use of a limited liability company, have the limited liability company be onboarded with a qualified custodian, and then we'll gift or sell the LLC interests to irrevocable trust structures for the benefit of the client.
That's the most common structure that I see. I mean, I'm not an estate planning lawyer. I leave that to smarter folks than I am. But the most common question I get is less of an estate planning concern and more of a, I don't want people coming after this. This is going to 1,000x over the next couple of years. Probably won't, but that's what they say. And the clients are always right. Always. So when they call and say that, they say, okay, I just have it in my personal name, I keep it on Coinbase, which, as Matt was talking about custodial arrangements, the one thing I'll say is that I would not keep anything on Coinbase or Gemini to the extent that you can avoid it, simply because they can just stop the outflows of any currency at any time they want. And that kind of harkens back to the other problem I said, which I also said crypto solves this, which is you need to go to the bank, I need my money. Bank says no for whatever reason, or they're closed. The same thing can happen on Coinbase. They can say, no, we're limiting your outflows to 3,000 a day or 5,000 a day, or worse. I've seen this happen. I have an account at Coinbase, and some person that I don't know sent me $500 worth of Solana token directly to my wallet. Well, that person's from an OFAC country, so guess what? Your wallet is now suspended and you can't do anything with it. I get that phone call. Not to scare everybody, but that's just a recommendation. Don't keep it on Coinbase. You want to either have it in a multi-signature custodial arrangement like Matt is talking about if you have large sums, or if you just want to protect it, keep it in a cold wallet. That's referred to a hot wallet before, that's the online wallet. A cold wallet is where you keep your keys offline. Those really can't be hacked. I know there was a breach a couple years ago with Ledger cold wallets, but they really can't be hacked. So just kind of word to the wise, if you are going to delve into this world and you're going to be accumulating Bitcoin or Ethereum or whatever it may be, look into it, at the very least a cold storage wallet where you move everything, all of your assets, off of Coinbase, off of Gemini, off of Kraken, whatever it may be, onto a device that you control. I get that question a lot.
Yeah, and there's, custody is one of the biggest questions, and in the Bitcoin space, there is this mantra, not your keys, not your coins. If you've been in Bitcoin for more than about 5 minutes, you've heard that phrase before. And what that means is, if you don't have control over the private key material, the odds are your Bitcoin is not really yours. Your Bitcoin is effectively a claim against somebody else's stash of Bitcoins. So in the case of most accounts at Coinbase or Kraken, or for example the ETFs, people say I have Bitcoin through an ETF, they don't actually have Bitcoin. They have a paper claim on BlackRock's Bitcoin, or if they have Strategy stock, they've got a paper claim on Strategy's cash of Bitcoin. Custody matters profoundly, and when we're dealing with large values of Bitcoin or other digital assets, the custody rule under the Investment Advisors Act becomes very relevant here, because in order to be a qualified custodian, the accounts are title held to the client at the custodian. So unlike a Coinbase account, if you've got title held custody with BitGo, for example, or with Tetra, or with Anchorage, those assets are actually title held to the client, or ideally to a trust or LLC within a client structure. So in the event of a failure at one of these custodians, the title held assets are not on the custodian's balance sheet. So in the event of, let's just pick on Anchorage for a second because they're huge and they're easy. If Anchorage were to fail, for whatever reason, the Office of the Comptroller of the Currency steps in as a custodian, guardian of the client's assets to safeguard the client's assets. They're not part of an insolvency proceeding or some litigation that would take place against Anchorage. So this is why the custody structure really matters. So whether you use, or a client is using Coinbase or Kraken to acquire Bitcoin, they should not stay there. They should either go into some type of wallet that the client unilaterally controls, or when it becomes economically material, something that qualifies as qualified custody, so we can make sure that the assets are protected in the event of an insolvency.
Does anybody have any questions? I know we're using a lot of, pop right up. Johnny on the spot.
So, with respect to the cold wallet solution, people try to link the bank because they want to keep all the money in the actors, their house first house, and some money. Likewise, what are some of the things you need regarding these keys, how to get that person
Yeah, that's a good one. The question, just for those who couldn't hear, was what do you do in the event of the person who lost their keys or lost their computer or loses the cold wallet? Losing the cold wallet itself is actually not the worst thing in the world, because if you have, when you open a wallet, whether it's online or a cold storage wallet, and I'll explain the difference in a minute, there's just automatically generated 12-word seed phrase, 12 to 24, depending on the device you use. And what you want to do is write that down. Don't save it on a file on your computer for the reasons that we're talking about, but you write that down and keep it somewhere else. Ultra wealthy people that we deal with, they keep that 12-word phrase in a safe deposit box. I mean, you're talking people with millions and millions of dollars. You're not going to keep that right next to your desk, so that anybody who breaks in can see it. Oh, there you go, right there. People do that. The horror story that I heard, and this is terrible, was in the Palisades fire. A lot of people lost their seed phrases to the fire, and if you lose it, there's no customer service to call. There's no way to retrieve it. So it really is incumbent upon you, if you're going to use a cold wallet and self-custodying, to make sure that that is somewhere safe. That's one of the biggest reasons why the structures that Matt is talking about, where you have multi-sig, where you're using a third-party custodian, yes, you have to pay them, but you don't have that problem when you use that, because they're the ones who control the access to it, by and large. They don't have unilateral access. They can't move money in and out of it without your consent, but it solves for that problem for sure.
Yeah, I think think about the private key, that seed, it's called a seed phrase, but it's referred to as the private key. Think of that as a combination, like a combination to a physical vault. A lot of times when clients have economically material values of Bitcoin that they want to maintain unilateral custody over, we'll encourage them to do a couple of different things. First of all, they're going to co-locate the seed phrases in different geographically distributed areas. So for example, if you have all of your key material in Palisade, California, and Palisade, California burns down and your fireproof safe is not as fireproof as you thought it was, it sure would be nice to make sure that your brother-in-law who lives in Chicago also has a copy of that combination lock, and or your sister in Florida has a combination, has that as well. And if you don't trust your brother-in-law or your sister, you can say, well, brother-in-law, you can have half of that code, and then somebody else can have the other half of that code. And so that's called sharding key material. So you could actually give one person that you kind of trust part of the combination, and somebody else that you also kind of trust the other part of the combination, and then let your kids or your spouse know who those people are to then retrieve that material in the event it becomes relevant. Kyle also said that the device itself is immaterial, and that's really important, because this is something I didn't realize. for probably the first year or so I was in the crypto space. There are these little peripheral devices, we've probably all seen them. Sometimes they look like a USB drive, sometimes they just look like a little dongle, but they control, it's basically a signature control device that allows you to cryptographically sign transfers of Bitcoin or Ethereum or whatever it is. If that device gets lost, if that device gets damaged or destroyed, no problem, because you can simply go buy another one. And if you have your combination, like I was just talking about, you can then re-access the wallet by re-entering the key phrase. So the device itself, we can live without that. What we have to have is the combination lock, or the combination to unlock it. Max.
I just wanted to add that Kyle and Matt are making excellent points on custody. A lot of customers in New York are getting hacked. Cyber attacks is a very big problem, especially if you keep funds on regulated exchanges like Coinbase, Gemini, and if you read terms and conditions, the risk of loss is on the customer. If credentials are compromised, exchange is not responsible. So having a self-custody and trust is a way to go.
Yeah, one thing I always like to tell people is, I mean, I'm pretty active in the space. I have, holdings. I'm not a billionaire, but I have zero ability to access anything I own with this device. I don't think people truly understand how easy these things are to hack. I don't care who you are. I don't care what app you put on it, unless you have an NSA encrypted phone. Like, you can get hacked walking down the street. That's just my 2 cents. And I've seen people, it happens. So,
6 watts.
yeah, right. It's a real problem.
You mentioned using a custodian as compared to a cold wallet. What's a range of what people pay for that kind of custody service?
So the question is, what do people usually pay for qualified custody on Bitcoin or crypto assets? I've seen it. We've negotiated very aggressive rates for our clients. I think the rack rate is usually about 30 basis points for qualified custody. Our clients don't pay that, but yeah, I think if you were to just try to reach out to one of the qualified custodians, you're going to be paying about 30 bips. And the thing that Kyle alluded to this a second ago, but what you get with qualified custody is actual qualified custody. The reason you don't pay for banking is because your dollars aren't actually at your bank. They're being rehypothecated. The bank is making a lot of money on the spread. When you're paying for qualified custody, it's like the Swiss model. Your Bitcoin is actually there. It's not getting rehypothecated. So you're actually paying a carrying cost to ensure that your assets are protected, just like you'd be paying somebody in Zurich to maintain custody of your gold. It's kind of it kind of breaks the mental model for people in the U.S., but it's a very traditional European model.
And like you said earlier, sorry, just real quick. Gemini and Coinbase are not in that qualified custodian category.
Coinbase has something they call Coinbase Prime, I believe, which I do think has a trust. They've got a trust. Coinbase has some type of trust through another jurisdiction, so they would meet the custody rule under the state trust.
So they're licensed trustee in New York.
New York, okay.
In New York, right?
Yeah.
But still, under New York banking rules, if someone gets hacked, there is no fiduciary duty to safeguard. So it's the same problem. Doesn't matter if you're keeping it in the trust.
Yeah.
Right now, we're told in a very kind of crypto-friendly administration and the like. Looking ahead 3-4 years, what are the sorts of things that may concern you about how government policy can change that would make it less attractive? Are there certain ideas being bashed around in think tanks that might concern you?
It's something that I talk very often about on shameless plug, my podcast, Block and Order. You can check it out. We cover everything from crypto to AI, but the main drive of that narrative, we're a friendlier administration, is peeling back the SEC's enforcement. Basically, what the SEC was doing during the prior administration, you probably heard the terms Operation Choke Point Anybody doing crypto, they were going to come after them. Anybody issuing a token, didn't matter what the circumstances were, you got enforcement action. Gary Gensler, the famous chair, the former chair, somewhat famously in our circle said, "Don't be afraid. We're here to help you. Come in and talk to us, and we will help you register." And my God, you'd be lucky if you did that and walked out without a subpoena, honestly, because they weren't there to help you. Now, Hester Peirce, who I've been able to work with, she's a commissioner and she's amazing. If you were to call up the SEC and say, "Look, I have this platform here. We want to launch a token. We don't know the exact securities law that would apply to this because the securities laws are not a direct one-to-one. They say just go public. Well, we're just launching a token. We don't have projected financials. We don't have audited financials. We don't have a business. Like, that's not what we do. If you were to call up the SEC now, they would work with you and say, you should do it this way, maybe change something so it is friendlier in that regard. To your question, what lies ahead? Difficult to predict. I mean, the cat's out of the bag. I don't foresee the government doing a complete 180 and saying no more of this, because the reality was people were opening up companies overseas and offshore and hiring people outside the United States and paying taxes outside the United States. None of that is attractive, and even the most myopic thinkers in Washington are not going to do that, I hope. We're probably looking at a change in Congress this year. I don't foresee that opening up crypto and figuring out what the regulations are going to look like are necessarily going to be top of mind. I hope I'm wrong. But I do think that the days of just you issuing a token to jail with you, those days are over.
Yeah, I think.
What about Department of Justice, compliance with Bank Secrecy Act? Those are not civil risks. That's felony.
Yeah, and we have seen a lot. You're still seeing some of those, but at the end of the day, even with a friendlier SEC and a friendlier DOJ, what they've been saying all along is, what you're doing is not securities, but you still have to. You can't commit fraud. If you promise a return on something that you're issuing, you still have to comply with the federal securities. Like, that really hasn't changed. My partner and I, we disagree on the Bank Secrecy Act application because he says those are arcane rules and it's ridiculous that they still enforce them. But they're still rules, and the saying that I don't agree with this rule, I don't agree with the speed limit, officer, don't give me a ticket, that doesn't fly. Same kind of concept. That's the argument we have on the show.
That has literally never worked for me. Yeah, I think from a personal wealth perspective, I think the Overton window has shifted so far in favor of Bitcoin specifically that I'm not worried about that. I think that the future risk is along the lines of what Kyle's talking about, and where if there is a change in posture with a new administration to then kind of re-envision or maybe kind of amplify the pressure on companies that are issuing tokens, I still don't think we've got enough legislative clarity around that yet. So there's a lot that's left to administrative interpretation. I also have this this general sense of unease at the number of Bitcoin treasury companies out there and crypto treasury companies. MicroStrategy, now Strategy is far and away the exhibit A for this, but these are publicly traded companies that really have no other business model than to accumulate Bitcoin or digital assets at scale. I don't know what the future is going to look like there. I'm not sure exactly how many different ways that could go badly, aside from just a bad market turn. There's just something that kind of weighs on me about those digital asset trading treasury companies that I just can't get comfortable with.
Yeah.
Just provide an additional comment. I think that the state banks, this is true as everyone else who custody Bitcoin and stable coins. I don't see them custody Ethereum, Solana, and any of the other stuff. Bitcoin, that's pretty itself. And so, as early as this year, the city is going to have free custody there. So
Yeah.
checking, savings, crypto, and that crypto button being stablecoin.
Yeah, so just for the reporting, the point back here was that Citi and other banks have announced that they're going to be custodying Bitcoin along with other checking accounts. And their digital asset accounts will first be Bitcoin and stable coins. Yeah, the question is going to be whether or not they are rehypothecating, which I think becomes a huge question mark. And I would say that I would believe that probably the top 2 or 3 tokens would be subject to custody pretty quickly after that. I would imagine that Ethereum, Solana, and the top 2 or 3 or 4 tokens beyond that would probably be subject to custody. With just the banks want their share of the revenue. They after resisting it for so long, now they're willing to actually profit from it.
Well, and they've been the ones, I mean, you use the word clarity. We don't have a lot of legislative clarity, and the Clarity Act is literally just sitting in congressional gridlock. Part of the reason is because the banks are saying, hey, yield, that's our thing. What are you doing? You can't do that. That's us. So we'll see who blinks first. I mean, I still think that it'll get done this year, but with each passing minute, that becomes further and further away.
I was also going to say that it seems to me, maybe I'm just Pollyannish about this, but it seems to me that digital assets are less partisan and more a generational issue. I think that there has been broad bipartisan support for Bitcoin, for other digital assets more broadly, and the divide seems to kind of break between the baby boom generation and younger generations. So I think we're seeing more bipartisan support of clarity, to borrow the pun, for pragmatic, sober-minded regulation and legislation around digital assets. And I mean, I've since lost count, but last time I looked, we had well over 50 billion in the Bitcoin ETFs alone, and those numbers are months old. So again, the Overton window has shifted very clearly in favor for Bitcoin specifically, and I think that a few of the other tokens will probably follow in some capacity.
How safe for the ETFs?
Well, how safe for the ETFs? I think the way we talked.
Not market fluctuation.
Yeah,
but
as far as
the
that.
assets overseas.
Well, my understanding is that the ETFs are largely custodied at Coinbase. Some of them are custodied at Anchorage, which is actually a qualified custodian with the federal banking charter. So I would look at the ETFs as maybe short-term exposure to Bitcoin's price action for those who are curious. I would not look at it as a proxy for Bitcoin ownership. Just like having a gold ETF is not owning gold. If you want gold, buy gold. If you want Bitcoin, buy Bitcoin. If you are curious to see what will happen over the course of the next 12 months before you make that decision, then buy an ETF. If you want to test your stomach for the volatility of Bitcoin. And then if you decide that you're going to make a long-term commitment for it, rotate out of the ETFs and actually get the asset itself.
Just real quick, sorry, one counter to that, not a counter, but an advantage to the ETF is you don't have to worry about the custodial arrangements that we've been talking about. So you don't have to worry about a private key and things like that. So that's one thing. But I agree with that.
Quick question back to your original structure. So I want to put on Bitcoin, which is a UTE, into a charitable remainder trust, or let's say a family foundation. You said that entity has to be able to custody it, but then it might be selling it immediately, right? What's happening?
So it may or may not sell it immediately. You can put Bitcoin, let's just use Bitcoin as the shorthand. You can put Bitcoin in any of these types of structures. In fact, if you just want to put Bitcoin in a donor-advised fund, there are some donor-advised fund sponsors that can do that. You can contribute your Bitcoin to a DAF, and most DAFs will immediately liquidate the Bitcoin, and then you have to reinvest in some type of lame investment structure that the DAF sponsor has.
That seems like a lot less of an asset than doing it in your own foundation.
It depends on what you want to do with it. So for example, if you're a Bitcoiner, you really don't want the donor advised fund to immediately liquidate the Bitcoin, especially if you think that Bitcoin is going to grow significantly in the future, and you want to kind of use it to endow some charities longer term. So option A would be to set up what's called an advisor managed fund within a donor advised fund. We do this for some of our clients, and we'll use a community foundation. Bespoke will serve as the asset manager, the sub manager for that, and we will then onboard the donor advised fund to Anchorage or BitGo or some other qualified Bitcoin custodian. The client will then donate the Bitcoin to the donor advised fund, and under the investment mandate, we can just continue to sit and manage the Bitcoin in that structure if clients want that type of structure. In the case of a donor advised, in the case of a charitable remainder trust or something like that, you've got two options. You can either find a trustee who will then onboard a trust-owned account to a qualified custodian, or what we found is more flexible, we'll have a limited liability company establish the qualified custody account and then put the limited liability company into the CRUT. Then, so client contributes the Bitcoin to the LLC vault owned by the charitable remainder trust, and then the charitable remainder trust manages the assets inside the CRUT according to the investment mandate there. When the client, as the investment manager of the LLC and or the investment trust advisor, decides to liquidate the Bitcoin is in a tax-exempt environment at this point. And so the CRUT payout comes out to the client just according to terms of the CRUT. It could continue to sell in Bitcoin for the next 15, 20 years potentially, so long as it makes the CRUT distributions.
Are there any big donor advised firms like Vanguard or Fidelity taking Bitcoin and selling it?
I think Fidelity is probably the only one that will maybe continue to sit on Bitcoin. And Fidelity was mining Bitcoin back in 2014, so they're kind of OGs in the space.
But they'll take it as a donation, and they may sell it.
Yeah, that's right. That's right. There are several donor advised fund sponsors that will say that they will accept Bitcoin, but in every case, with the possible exception of Fidelity, they will liquidate it immediately. And then you've got just a fairly tepid range of options for investment portfolios within those sponsors. Yes, sir.
Can a New York resident turn it into a tangible asset that could be outside New York to avoid New York estate tax?
I'm not a New York attorney. I will tell you
So
that.
we tax, like any state with an estate tax.
Yeah.
You tax your residents on everything except real and tangible property that's elsewhere. And you tax your non-residents on real and tangible property that's in your state.
So I think, and I'm going to be way out of my skis here, so forgive me in advance for anything I say that may constitute malpractice. My understanding is that New York will still recognize a completed gift, non-grantor trust, without a throwback type of application to the underlying estate income tax.
No, estate tax.
Oh, estate
I
tax.
could buy I actually live in Jersey, which we're going to talk about next month, I think, but a New Yorker can buy a building in New Jersey and avoid state estate tax. A New Yorker can buy a gold brick and put it in some other in New Jersey or wherever, Delaware, outside state estate tax.
Yeah.
Is there any way at all that a New Yorker could buy a Bitcoin or 100 Bitcoins and manage to have them be tangible in some way and outside New York?
I don't know how it would be tangible.
I don't know either.
I would think though that depending on the trust structure, you might be able to establish a completed gift non-grantor trust in some place like Delaware.
Could do
And
that
so,
with a dollar bill, but
yeah, I don't know how you turn a
Turn
digital
asset
asset into a tangible for that purpose.
okay, I didn't
Yeah.
think so.
What about the self-custody wallet? If you're keeping it on USB drive?
Well, the question is if it's on a drive, but then remember, that's not where the Bitcoin is. That's a signature device. That is not the Bitcoin. Where is Bitcoin? It's everywhere. It's nowhere and it's everywhere.
I think there's an argument, because this is something I'm worried about in the international space, the intangible versus intangible. So you couldn't access the value but from that piece of hardware. I'm not saying that's a winning argument, but I think that's the argument.
So Jerry, I think maybe a different analysis would be, so back a long time ago, Bitcoin actually circulated on what's called Cascacious coins. And it was a physical coin, and on that coin was engraved the seed phrase or the private key, and you have to have that material in order to control the Bitcoin represented by that Cascacious coin. You could buy a 1 token coin, a 10 token, a 100 token, that kind of stuff. I don't know that the fob or the peripheral device would constitute that. However, I would make the argument that if I go to Delaware, for example, and I create a Bitcoin wallet in Delaware, I engrave the seed phrase on resilient material in Delaware, I store it in Delaware, and I can only, and I don't have a copy of that in New York or some other place. I think that maybe you could make the argument that the tangible property represented by that seed material is that seed phrase is in Delaware. The challenge with that becomes, what happens if you've got a really good memory and you happen to remember your seed phrase? It's like, okay, well then it's kind of everywhere, isn't it? Because it's not the physical material that allows you to control it. It's the knowledge of the words that allow you to recover the combination to the lock. I mean, how do you've got the combination to your gold vault. I mean, yeah, the gold is physically someplace, but the combination is in your head. Now, when Bitcoin exists in a globally distributed network and the combination unlocks the vault wherever you happen to be, whether you're in New York or Delaware or Argentina, doesn't make any difference. I don't know how you take a totally digital asset and make it tangible. Yes?
So what if the trustee is the only one, you open it in Delaware, the trustee is the only one who has the private key because they purchase, like you give them money, they purchase, they have the private key.
Yeah, I think
you've never received it?
I think that would probably establish that. You'd probably fund the trust with dollars and then direct the trustee to buy the Bitcoin.
Excellent question.
Yeah, that's a new one. I hadn't had that before. I love that question.
That's a good one.
Yeah, and just kind of round that out a little bit. When I'm funding Bitcoin to a trust structure, I'm not taking my private combination and giving that private combination to the fiduciary. That fiduciary has to open up a qualified custody vault, and I transfer the Bitcoin from the vault I control to the vault my fiduciary controls. And so I don't have, if I'm a New York resident and my trustee is in Delaware, I transfer my Bitcoin by signing a Bitcoin transaction from my wallet I control unilaterally to a wallet that my trustee controls. And in doing so, I have changed the governing situs from New York to Delaware in that case.
I'm not an estate or tax planning attorney, so yeah,
But
that's
it's a
great.
big gift. We don't tax gifts as long as you live 3 years after you make the gift.
You're talking for New York purposes?
Yeah, there's no New York.
Yeah, there's no separate New York gift tax?
There was, it got repealed,
Okay.
January 1 of 2000. We did have it, and we're in the process of requesting gift tax returns for somebody for 1999.
Yeah, so if you don't have state level gift tax, then gifting it out of your estate during your life is a great
As
call.
long as you live 3 years.
As long as you live 3 years and you don't get the clawback. You still have the federal exemption to deal with, but you know, 15 million bucks before you have to worry about that a whole lot. What else?
You know, besides Bitcoin, you know the one coin token that people call me the most about? XRP.
Oh, yeah.
It's always XRP. I don't get it. Everyone's like, it's gonna million X. You're like,
Moon.
cool. Well, let me know when that happens, I guess. It's not worth that much.
Probably coming up on time. So you guys, I think, are gonna hang around a few more minutes
Yeah.
if anyone has questions, but
What time we go to?
thanks.
I have no idea.
1:10?
110.
Oh, 110, well, we've done it then. Sweet. Yeah, great. Well, thanks everybody for your attention and for the questions.
Yeah, thank you, everybody. Appreciate it.